Module 7. Capital gains. The capital gains tax rate refers to the tax rate that applies to the profits earned from the sale of a capital asset, such as stocks, real estate, or other investments, held for more than 1 year. The capital gain rate is the percentage of gain earned through a transaction. When an individual sells a capital asset, the difference between the purchase price, also called the basis, or cost basis, and the sale price is called the capital gain. The capital gain is long-term if the asset was held for over a year. Long-term capital gains are taxed lower than ordinary income, such as wages and salaries. The individual's tax bracket determines the capital gain tax rate. For example, in the United States, the capital gain tax rate for individuals in the lowest tax bracket is 0%, while those in the highest tax bracket pay a capital gains tax rate of 20. Much lower than the 39.6% highest tax bracket for ordinary income. It is important to note that capital gains taxes only apply to realized gains, meaning they only become taxable when the asset is sold. Until then, they are considered unrealized gains and are not taxed. Additionally, strategies, such as tax loss harvesting, can help individuals minimize their capital gains taxes. For example, if a stock is bought for $30 and sold for $33 1 year later, the capital gain rate is 10%. The capital gain rate is calculated by dividing the capital gain by the initial investment, and then multiplying it by 100 to get a percentage. In this case, the initial investment was $30, and the stock was sold for $33, so the capital gain is sale price minus purchase price. In this case, that is $33 minus $30, which, of course, is $3. The percentage capital gain rate can be calculated as the capital gain divided by the purchase price. In this case, that's $3 divided by $30, which is 0.1, or 10%. Capital. Capital refers to the financial resources, such as money or assets, that a company or individual has available to invest in business operations, purchase goods or services, or generate income. Capital can be obtained through various means, such as personal savings, bank loans, investments, or issuing shares of stock. Equity cost of capital. Equity cost of capital, or the cost of equity, is the return investors require to invest in a company's common stock. It represents the opportunity cost of investing in the company's equity, unlike other investments with similar risk profiles. The equity cost of capital is significant because it calculates a company's overall cost. This is the weighted average of the costs of all sources of financing, including equity, debt, and any other financing instruments. Companies use the overall cost of capital to make investment decisions and evaluate the financial performance of their investments. There are several methods for calculating the equity cost of capital, but the most commonly used method is the capital asset pricing model, which is sometimes abbreviated as CAPM. This model calculates the cost of equity as the risk-free rate of return plus a risk premium based on the company's beta, which measures the volatility of the company's stock price relative to the market as a whole. A company with the same volatility as the market as a whole would have a beta of 1. The formula for calculating the cost of equity using the capital asset pricing model is cost of equity equals risk-free rate, plus beta times the amount by which the market return exceeds the risk-free rate. For example, if the risk-free rate is 5%, the company's beta is 1.4, and the market return is 7%, then the cost of equity would be 5% plus 1.4 times the 2%, which represents the excessive market return over the risk-free rate. This comes to 5% plus 2.8%, for a total of 7.8%. This means that investors would typically require a 7.8% return to invest in the company's equity, based on the risk level of the company's stock compared to the overall market. The equity cost of capital is essential to a company's overall cost and is used in financial analysis and decision-making. The dividend discount model. The dividend discount model is another method to calculate the projected value for a stock. In essence, the model calculates the stock as being worth the present value of all the future dividends. Since a company has no known end date, it can be compared to a perpetuity, and the dividend discount model thus uses the perpetuities formula to calculate the projected value of the stock. This is the payment, which is the annual projected dividend, divided by the rate minus the growth. In the case of a stock, the rate is the equity cost of capital, which means the cost of financing the company's value, and the growth rate is the expected rate by which the dividends will grow each year. For example, assume that XYZ Corp will pay a dividend of $2.40 per share this year. It is expected that this dividend will grow by 2% each year in the future. The firm's equity cost of capital is 6%. What is XYZ's projected stock price? We can apply the perpetuities formula of payment divided by rate minus growth. The payment is $2.40 per share. The rate is 6% since that is the company's cost of capital. The growth is 2%. So the formula would boil down to $2.40 divided by 4%, which comes to $60. Thus, the projected price of a share would be $60. Of course, neither the capital asset pricing model nor the dividend discount model will necessarily show the actual stock price. The market price of a stock includes other factors, such as what people expect of the company and its long-term prospects. Still, these formulas can help establish what the fundamentals say about the company's value. Share profit. Share profit refers to the portion of a company's earnings distributed among its shareholders as dividends, or as an increase in the share price. When a company earns a profit, it can choose to reinvest the earnings back into the company or distribute a portion of the earnings to its shareholders. If a company distributes a portion of its earnings as dividends, its dividend policy determines the amount paid to each shareholder. This can include a fixed amount per share, a percentage of earnings, or a combination of both. Shareholders can then use the dividend payments as income or reinvest them into the company by purchasing additional shares. Alternatively, a company can use its earnings to increase the value of its shares. This can be done through share buybacks or investing in growth opportunities to increase the company's future earnings. When the company's earnings increase, the value of its shares may also increase, allowing shareholders to realize a profit if they choose to sell their shares. Overall, the amount of profit a shareholder can realize from their investment in a company will depend on various factors, including the company's dividend policy, earnings growth rate, and market conditions. For example, assume DEF Corporation has 550 million shares outstanding. It expects earnings at the end of the year of $770 million. DEF pays out 50% of its earnings each year as dividends to its shareholders. The rest it keeps in the company to reinvest or repurchases its own outstanding shares. Also assume DEF's earnings are expected to grow by 3% annually, and the payout rates do not change. The equity cost of capital is 8%. Its earnings per share are $770 million divided by 550 million, of $1.40 per share. Only 70 cents will actually be given out since DEF only distributes half its income as dividends. Using the divided discount model, we'd calculate its share price as 70 cents per share divided by its cost of capital, 8%, minus its growth rate, 3, for a total of 70 cents divided by 5%. This would make its share price $14. However, this would account for only half the profits. The remaining 50% would still help the company grow stronger. So, its share price would, even under the dividend discount model, likely be higher than $14. Net present value. Net present value, often abbreviated as NPV, is a financial metric that helps evaluate an investment's profitability by comparing the present value of all future cash inflows, from the investment to the initial cost of the investment. The basic concept of NPV is based on the time value of money principal, which we covered earlier in the course. To calculate the NPV of an investment, the following steps need to be taken. First, estimate all the expected cash inflows and outflows from the investment for each period. Subtracting the latter from the former shows the net income. Second, determine the appropriate discount rate, usually the company's cost of capital. Third, calculate the present value of each cash inflow or outflow using the discount rate and the period when it will occur. Finally, add up all the present values of the expected net cash flows to determine the net present value. If the NPV is higher than the initial investment necessary to generate these cash flows, the investment is generally considered a good investment. Assume a cab owner invests $50,000 in a new van that he will use as a cab, and must pay an interest rate of 5% on that money. The 5% is his cost of capital. The cab owner expects to generate the following amounts in net income: $10,000 in year 1, $15,000 in year 2, $20,000 in year 3, $25,000 in year 4, and $30,000 in year 5. After year 5, the car will be so beat up and, for our purposes, worthless. Let's calculate the net present value. We can use Excel to figure out the present value of each year's cash flow. We'll use the equals PV formula, since we're looking for present value. The rate will stay the same for each cash flow, 5%, which is the cost of capital, and the number of periods is the number of years ahead we're looking. The future value is the expected net income. For the first year, use the equals PV formula with the rate as 0.05. The NPER is 1, since it's year 1. The payment is 0 since the year's cash flow is all we're focusing on. The future value is $10,000 and the type, as always, is 0. Excel tells us that the present value is $9,523.81. For the second year, the NPER is 2 since it's year 2. The payment is still 0. The future, this time, is $15,000. The type, of course, is 0. This time, Excel gives us a present value of $13,605.44. Doing the same 3 more times, we get present values of $17,276.75 in year 3, $20,567.56 in year 4, and $23,505.78 in year 5. Add the 5 cash flows up, and you get a total of $84,479.35. This is the net present value. Since it's more than the $50,000 initial investment, this is projected to be a good investment. Of course, the driver might consider his own time and decided whether to do this venture, but from a pure numbers standpoint, the NPV is positive.